Hey everyone, Bill Ethman here for Money Evolution. In today's video, I'm going to be talking about how to get started investing. So whether you're brand new to investing, you're just starting to put some money away for the very first time, or even if you're somebody that's already been investing for a number of years, we're going to start off with something very basic. We're going to talk about some of the basic principles behind investing, talking about stocks versus bonds or equity versus debt, and some of the considerations that you should be thinking about as you're starting to put together your portfolio. So even again, if you're a more experienced investor, I think you're still going to get some very good value out of this video and the videos that we're going to do later on in this series that we're going to be working on here. So let's dive right in. So the first thing I want to talk about here as it pertains to starting to invest are what I call the three basic pillars of investing. Pillar number one is a business. Not everybody is going to necessarily participate in a business, but this is something that you're actively doing. Could be a small business, could be a big business, could be a business that's actually more of a side hustle type of a thing. But for many of you, this could be one of those key fundamentals for you becoming financially independent. Another type of investing is real estate investing. Now, if you've watched my channel here, you probably know that I'm a pretty big fan of investing in real estate as one of those avenues towards financial independence. But in today's video, what I want to talk about really is that third leg, probably the most common area of investing that most people are familiar with, and that's what we call paper asset investing, basically stocks and bonds. So we're going to take a dive into this and hopefully give you some education that you can use as you're starting to build your portfolio. And even if you are a more experienced investor, I think you're still going to find some very good value here with today's video because we're going to get into some of the historical returns of some of these different asset classes, and as you start to put together your portfolio, understanding maybe why you're doing certain things with your portfolio, and especially for those of you that might be getting closer to retirement, I think understanding that risk is going to be something very valuable. So let's dive in on the whiteboard here and let's get started talking about the first basic premise, and that is the difference between stocks and bonds. Okay, so when it comes to paper asset investing, there's really two broad categories of investments that we could be looking at. The first type of investment would be what we call equity investment, and the second type is what is known as debt investing. And now you might be thinking, hey, what does that mean? Those may be terms that you're not 100% familiar with, but let me break it down to something a little bit more simple. When we talk about equity investing, we're really talking about ownership usually in stocks. And by owning shares of a stock, you're actually participating in the ownership of that company and the profitability or lack of profitability in that particular company. When we talk about debt investing, we're really talking about a couple of things. It could be bonds. So you lend money to a particular company or entity, or it could also be referred to as fixed income. And to kind of illustrate this a little bit more closely, let me give you kind of a little bit of an example here. Let me clear my board here. And let's use an example of you buying a business. Let's just say you're driving home from work one day and you're getting a little tired of the rat race and you pass by this ice cream shop that's got a for sale sign on it. So you call the owner, you ask them all the details of the ice cream shop, how much are they asking for it, the profitability of it, and things like that. And so after learning all of that, you decide that you're going to put an offer in on this ice cream shop. And let's just say that the owner is asking $100,000 for that ice cream shop. Now, there's a couple of different things. Okay, let's say, you know, if you have $100,000, you could just go pay cash for the business. That's certainly one way of financing that. But there's two other ways of financing that as well. So one way would be to go to a bank, or it could be a friend, or it could be almost anybody. It could be a venture capitalist. But you could go to somebody and actually borrow money. And so when you borrow money, you might say, hey, I'll put down 20%, just as an example. So I'll put down $20,000 of my own money, and I'm going to borrow $80,000 from somebody or some entity, and then I'm going to agree to pay that $80,000 back over a set period of time. I'm going to agree probably to an interest rate. So I might say, hey, I'll agree to pay you 6% interest, and I'll make regular monthly payments over the course of 5 years or 10 years or whatever it is that you negotiate. And eventually that $80,000 is going to be paid off to zero. And hopefully your business that you just bought makes enough money for you to pay that loan off and be able to make those regular payments. That's, again, what we call fixed income, because this is something that is a fixed rate of interest that you're paying back and that you're paying to that financial entity. So if you're an investor, you could be on the other side of this. So here we use the example of you going out to buy the business and take out that loan, but you could also be the person that's lending the money out to the company, or could be lending money out to the U.S. government or to a municipality or to anybody else, and that would still be considered that fixed income type of an example. Another way to finance a business would be through equity. Okay, and an equity would be something. And if you ever watch Shark Tank as maybe a good example there, the sharks oftentimes are actually getting equity ownership in those businesses. So in exchange for lending or giving that company money, they're actually, instead of agreeing to a fixed payment of return, they're actually going to get ownership in that business. So you might say, hey, I'll lend you, let's say, the $80,000, and in exchange, maybe I'll take 25% of that business. And so now that person is going to participate in the ownership of that company. Now, a couple basic things here about the equity versus the fixed income. Number one, the fixed income, if that business were to fail, if there's any equity left in the business, the fixed income people are going to get their money back first. And only after all of that debt has been paid off would anybody get their money back for the equity. So in simple terms, the equity position is going to be a little bit riskier than the fixed income position, because the equity people are only going to get their money after that fixed income is paid. Another thing too is, let's say we're talking about dividends, and dividends are something very common on stocks, and those dividend payments are probably not going to be made unless they're able to make all of these fixed income payments as well. So you're not likely going to get your money back if there's not enough profitability to be able to pay those fixed income investors. So hopefully that makes sense. Hopefully it gives you a little bit of an idea of just the general idea between fixed income and equity investing. Okay, so now let's talk about how this pertains to you investing your money. Let's clear our whiteboard again here. And what we want to think about here is the level of risk that we're taking on with our portfolio. And obviously one of the first things we want to talk about doing is balancing out the amount of our money that we have invested in the equity side of those paper assets versus the fixed income side of those paper assets. So historically, if we look at the returns for stocks, those are going to produce generally speaking, a higher upside potential, but it's also going to be we'll put potential down here, but it's also going to be higher risk. And so if you think of it like this, when we talk about that fixed income investment, if you've agreed to invest your money in a company and lend them money at 5% interest, that company's probably not going to say, hey, Bill over here has been really good to us. He lent us the money. We're doing very well. We agreed to pay him 5% interest, but we're actually going to give him 6% or 7%. No company is going to probably do that. So you're locked into that. Again, that's hence the name, the fixed income. On the stock market side, though, if that company is doing well and that company is making profits, then that stock price is probably going to go up, because people are going to view that company as, hey, this company's making money, they're adding new customers, they're getting new business, and the profitability of that company is going up. So you're participating in those returns with literally no upside or no upside limit, I guess is what I wanted to say there, on the potential of what you could make on that. And again, the fixed income is going to be more limited. So what do we want to think about here? So as you're going through your investment life, generally speaking, if you're a younger investor or you're willing to take on a little bit more risk, you might want to have more of an emphasis on the stock or the equity side of the equation there. And if you're getting closer to retirement or you're a little bit more risk averse, then you might want to have a little bit more money over here in the fixed income side of things. So let's take a look at a couple of charts. I'm going to try to get these up on the screen here. Okay, so here we're looking at the long-term historical returns and the amount of risk associated with those returns for a couple of our major asset classes. So this is something that's taken from the JP Morgan Guide to the Markets. It's a great resource. It's totally free to get access to that. If you actually just go to internet search browser and type in JP Morgan Guide to the Markets, you should be able to find a link there within the first couple of returns and get into this. And so this is one of those charts. This is page 64 of what is a very large large PDF. But I like this because it illustrates some of those risk and return characteristics and how the longer time period that you have for investing, it tends to kind of minimize some of those risks. So when we look at a one-year basis, we see that stocks, as an example, have averaged 11% compounded rate of return over this period of time, going all the way back to 1950. The biggest year over that time period was a 47% return for the stock market. So, hey, that'd be a great return. I'd certainly be very happy with the 47% return. But also over a one-year time period, there was a 39% loss in there as well. So again, we don't have a crystal ball on the market to know whether these next 12 months are going to be one of those best years or one of the worst years. So if we're going to be investing in the stock market, we need to be prepared to take a loss of 39%. And there can also be potentially bigger losses in there too, because this year over calendar years. Okay, so we start looking at kind of maximum drawdown. If we think about like the 2000 to 2002 downturn that happened over a 3-year time period, there was successive losses in 3 years: 2000, 2001, and 2002. I think the total loss was actually up around 50%. So we need to be prepared with that as we're looking at investing. Bonds historically have averaged about 5.8%. So, a little bit over half of the return of the stock market, but you can see, much lower volatility historically. The worst one-year time period for bonds was minus 8%. So if you have a shorter time horizon, that's where you might want to consider having bonds. And then they also look at a portfolio that's a 50-50 split between stocks and bonds. We start looking out over 5-year time periods. Now, this is where I think it starts getting really interesting. So the best 5-year time period for the stock market was 28%. The worst 5-year time period for stocks was minus 3%. So that's a lot less risk. If we're looking at it over 5 years, we started looking at 10 years. The worst 10-year time period for stocks was minus 1%. And if we look at 20%, the worst 10-year time period for stocks was 6%. That's actually an annual basis. So that's not just total return. That's actually 6% per year, and the best 20-year time period for stocks was 17% compounded per year. When we look at bonds, bonds actually have, even though they're safer, if we're looking at longer time periods, they actually have a lower historical average in terms of the worst time period ever on record for stocks. Now, when we look at this over a longer period, we can see this in a little bit different way. And of course, there's different types of stocks. We're not going to get into that all together in this video. But when we look at this historically, this is a Morningstar report that goes all the way back to 1926. So a little bit longer chart here. But small cap stocks have averaged about 11.8% over this period of time. Large stocks at 10%. And then they also break down a couple different types of bonds. Government bonds, 5.5%. And Treasury bills at 3.3%. So it gives you a little bit of perspective there on these different types of returns and how we might want to think about putting together our portfolio. Okay, so now let's go back to our whiteboard here and let's wrap things up and let's talk about how this new information that we've just learned today, how that applies to our individual portfolios. Again, those two main asset classes are equity investing and fixed income or debt investing. And there's a number of different ways that you can go about doing this. So what I want you to kind of keep things simple here for today. If it's starting to invest versus not starting to invest, I don't want you to get too hung up in the weeds and really get buried in the research if that means that you're not going to go forward with putting together an investment portfolio or investment plan for yourself. So there's a number of different ways you can do this. So one thing that you might be familiar with, and it's not my favorite type of investing, but it is something that is readily available to you, probably if you have a 401k or 403b plan through work. But target date funds can be a way for you to say, hey, I'm in a position right now, I want to start investing, I'm not really sure exactly how to go about doing. A target date fund is probably not going to steer you in too wrong of a place. You're going to get some pretty good value out of that. And the idea with a target date fund is it's going to usually be age-based. And what that means is that your asset allocation earlier on, if let's say you're in your 20s, is going to have a much higher exposure to that equities and a much lower exposure to the fixed income part of the equation there. So you're going to have more of that risk, because the idea is that if you're in your 20s, you have a lot of time probably until you're going to need to start taking this money out, ideally probably in retirement. And as you go closer to retirement, if you're somebody that's in your 50s, that might be almost the opposite. You might have maybe 40% to 60% invested in stocks, and the rest of it would be in fixed income. And the idea there is we want to reduce that amount of risk as you get closer to retirement. So a target date fund is one of those ways that you can do that. There's a number of other ways that you can do it. Index fund investing, and we're going to talk about that on some of the other videos here. We're going to take a deeper dive. I've already talked about index funds. Again, I think there's a lot of potential risks with that, but one option is just to say, hey, I'm going to put some money in. I want to be an equity fund investor. So you might look at the S&P 500. And again, the S&P 500 is certainly going to have some risks with it. It's going to be probably more aligned with that other chart we were looking at, with that big up and the big down potential over a one-year basis. But the S&P 500, it could be another one of those. Mutual funds could be another option. And there are literally thousands of different mutual funds. There's actually thousands of different indexes. I actually read here not too long ago, there's actually more indexes than there are stocks that are publicly traded on the stock exchanges. So there's a lot to pick from here, but obviously the S&P is one of those big ones. Mutual funds, again, there's thousands of those, and you could do some research, read some publications, try to find a manager that has some good performance. One thing that I like, and we're going to talk about as well in some of these other videos, factor investing. And there's a couple different ways to get into that, but basically it's looking at maybe what we think is a better way to index, where we're taking an index and we're looking for characteristics that we believe have above average attributes for long-term performance. Things like companies that have good return on assets, or they have low debt, they have good growth, their earnings are going up in a positive direction, and so you can do that through ETFs. And again, we're kind of drilling down from something that's very basic, like a target date fund, into indexes, maybe some mutual funds, some factor investing. And then the last thing, and this is something that only for those of you that are I just think I spelled that wrong, individual stocks here, trying to write and talk at the same time. But individual stocks could be another way for you to get into the stock market. But again, that's something that's going to require the most amount of knowledge and expertise, and it's going to also require the biggest amount of work too. So you really have to do your homework, and you have to do your homework with all this stuff, quite honestly. But as you get into those individual stocks, that's where it really kind of has that where you have to really know what you're doing there on that. So anyway, I hope that was a pretty good overview on how to start investing. The biggest thing I can tell you is just start. If you're in a position right now where maybe you don't have enough money to start investing and you want to get started, but you're trying to figure out your cash flow, you can check out some of the links below this video. We've got some great video series that kind of take a step further back, and that is getting your whole financial house in order and understanding where some of the money is going so that you have the money to invest. And that's one of the critical components of getting to that point where you're going to be financially independent. So if you like this video, please hit that subscribe button, hit the like button also. That's how we get that out there to everybody. Share the video, and check out the links below. We also have our new resource center that's going to have a lot of additional content that's not available here on the YouTube channel. So there'll be a link to that. Very easy. Once you register for that, you'll get access to all of the information in the resource center. Plus, it'll also give you access to our live events that we do on a regular basis as well. So check that out, and I will see you back here in one of our next videos. Have a great day. Thanks.